Easing inflation has investors clamoring for growth stocks and pushing equity markets higher in hopes that the Fed will reverse course of higher rates in the second half of 2023. Is this a sustainable rally or just a head fake to get investors fully invested ahead of a recession-based sell-off? That action starts now. January proved many forecasters wrong as equity markets soared higher. The major indices reversed their order of dominance from the last several months, with the Nasdaq Composite easily taking over the lead by posting a gain of 9.68%. However, the S&P 500 and Dow Jones Industrial finished up nicely as well, with returns of 5.8% and 2.91% respectively. Large cap growth stocks and tech stocks were able to catch a major bounce this month after posting some dismal returns for the last 12 months. This should not come as a surprise to regular viewers of this video. Even though I have been pounding the table about not fighting the Fed, that does not mean there can't be pockets where the market reacts inversely to the efforts of the Fed. Importantly, quick upticks like these in a slowing economy can often be head fakes that trick investors and portfolio managers into increasing their equity exposure over a fear of missing out or in an effort to make up losses and ultimately find themselves in a deep sell-off shortly thereafter. I can't emphasize this enough. It is not time to try and be a superhero. Bond yields fell across the board for the month, with the 5-year hitting at 3.63% and the 10-year at 3.52%. The 30-year yield also moved lower to 3.66%. The 10-2 spread closed at negative 70 basis points, and as I write this, we are awaiting the Fed's decision to raise rates another anticipated 0.25%. If the commentary from Powell indicates a dovish outlook for future hikes, expect the 10-2 spread to narrow. Alternatively, you can expect a widening if you hear a more hawkish tone. Just like last month, crude oil recovered from a swift drop early in the month to close slightly lower at $80.45 a barrel. China's reopening is helping improve sentiment. However, all indications from the Fed will control future moves. On the charts, the 50-day moving average will act as initial support at 77.85, while 80.5 and to 81.5 will offer initial resistance to the upside. Copper was strong all month and finished up at $4.22. However, there is room for an 8 to 10% correction before prices find support from Q4 22, just below $4. A further breakdown below $3.75, though, would be a more ominous anecdotal signal for the economy from the industrial metals market. Gold also posted a strong uptick this month, managing to close at $1,928.40 an ounce. It seems the 2023 rally has at least temporarily stalled in the mid-1900s this week, but the conclusion of the Fed meeting could change that. A dovish tone by the FOMC would ignite a continuation higher in gold, while another hawkish surprise could easily see half of 2023's roughly 6% gain be given back today. Last month, I stated we could see a positive tailwind for risk assets if we saw the dollar decline towards 100. Well, that is exactly what happened, with the dollar closing out at 102.08 and risk assets soared. Any indication of a potential pause from the Fed on rate hikes will most likely see the dollar fall even further through 101. Any language to the contrary would send the dollar index higher through 103, if not more. Clearly, inflation is declining. While we are seeing that pretty much everywhere, we should not expect it to be a linear process. There will be gains and some setbacks, but broadly, disinflation remains a positive for the market and certainly much better than where we were last year, and that's encouraging. I am doubling down on my guidance from last month to be very cautious of chasing any rally. As you know, we substantially outperformed the market last year, and we are doing the same this year, running neck and neck with the Nasdaq, all while remaining our 40% cash position. I have seen 2023 S&P 500 earnings projections anywhere between $200 and $231. I tell you this because multiplying that number, or one in the range, by a reasonable multiple for the economic conditions that we're facing would give you a good idea of where the year-end value could be for the S&P 500. A multiple of 16 would give us a range of 3,200 to 3,696, while a multiple for a stronger economic condition of say 20 would present a valuation range of 4,000 to 4,620. Consider the intentions of the Fed to continue to raise rates and potentially keep them higher for a longer period of time. It is unlikely that we are headed into a strong economic environment. And this is exactly why there is a strong belief that the current rally may be a head fake ahead of a tracement to 3,000 or 3,500 over the next few months. This is also why our models continue to maintain a 40% cash position. However, there will be a time to put that cash to work. That will most likely happen when the economy is not doing well and confidence is at a low. That is generally a good time to start putting cash to work. As such, a correction to 3,500 in the S&P 500 would most likely be a reasonable time to start putting it to work. For the month of February, the cash allocation in our equity models remains at 40% due to the model's more aggressive nature. As I stated a minute ago, we finished 2022 substantially better than the indices, and after just the first month of 2023, we are greatly outperforming them again this year. Our broad focus is now on international equities, cash, and commodities. In international equities, our focus is on European emerging, Latin America, and Europe developed. As for commodities, our focus is on industrial metals and precious metals. As a reminder, my current allocation is not a recommendation. Regardless of what happens next, investors like you need to have a simple and yet solid financial plan that reduces risks, costs, and taxes while securing the necessary income you need to maintain your lifestyle throughout retirement. So, if you don't have a plan or you're not comfortable with the plan you have, call me today to get pointed in the right direction. I'm Chad Kuntz, and that puts a wrap on the February 2023 Market Action Report. Thanks for joining me. It's time for me to get back to the markets, and that action starts now.